Welcome to the INREM podcast, where we discuss the law for real estate investors. Andy and Sean are both attorneys. Nothing said in this discussion should be considered legal advice. We're simply providing information and education. You should consult with an attorney in your state regarding any specific legal issue that you may have. Hey, everybody. Thanks for joining the show. Today, our topic is tax planning for real estate investors. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, give us a like, subscribe to our channel, whether it be on YouTube or Facebook. Subscribe so you can keep up to date with what's going on. With that, Sean, give us our legal update.
So today I want to talk about how an estate plan can complement a real estate investor's business holdings. Last week we had Natalia Grice on with us, and she talked about business and succession planning for real estate investors, and as well as estate planning. And I just kind of want to follow up on that and touch on that a little bit. So an estate plan generally consists of a few instruments, right? The main instrument, or the driving force of generally an estate plan, is a trust. And unless you're doing high-end tax planning, the trust is what we describe as a revocable trust, right? It can be amended, changed, revised. There's no restrictions on that. And what that trust does, and the main elements of that trust, is it basically allows your assets to be immediately handled or dealt with in the case that you become incapacitated or you pass away. And you don't have to go into court. You don't have to obtain court approval. The trust lives on after you, basically. And so it avoids probate. The second thing that a trust does is allows for provisions for minors. If you have children under 18, or for that matter, under 30 or 25 or whatever age you deem appropriate for somebody to have any form of assets or substantial assets, you can put restrictions in there and say, well, until they turn 25, I'm going to allow my successor trustee, the trusted person that you've appointed to handle your assets if something should happen to you, I'm going to allow them to be in control of those assets and have discretion on how to use those funds. Now, how does that trust then play into your business holdings? Well, if something happens to you and you own a business, and many investors own businesses with partners, or they're in transactions, whether by joint venture or otherwise, with other parties, right? And so if the investor doesn't have an estate plan in place, well, then what happens is, if something happens to them, everything grinds to a halt. And then what you have happen is you have the court basically make a determination based upon statute, if you will, who is going to then step in and handle the affairs, handle that investor's business affairs. It could be somebody that the investor would never want to be in that position. It could be somebody that is very difficult to deal with.
Could even be a creditor, right?
It even could be a creditor. We've had that, right? Where we've either had or gone on behalf of creditors into probate court and had them appointed.
Sure.
So you just never know, who's going to fall on that order of priority, and have to be involved with those business holdings. So the way an estate plan complements an investor's business holdings, it allows them to basically figure out who that trusted person is that will be able to step in and won't basically, ruin their business relationships, harm those that they're in business with, harm their businesses, and will basically do the right thing by their business, by their business partners. It also then allows for the orderly succession of assets to make sure that, hey, I'm a successful investor, right? I have millions of dollars worth of holdings. And all of a sudden now I have, a 19-year-old child who's going to have that, have access to those holdings, and they're going to go have a fun weekend in Vegas or whatever they're going to do with it, right? Um, you just never know what's going to happen to those assets. So by having a good, solid estate plan in place where you are able, and in a position to make good, strong, intelligent decisions regarding your affairs should something happen to you, it complements your business holdings and allows for your business to continue, or for you to even leave a legacy should something happen to you and should you no longer be able to operate within that business setting.
All right, with that, we're going to go into today's topic. Today, we're talking about everybody's favorite topic, the topic they all want to know about and don't want to know about all at the same time, and that's taxation. Today, our topic is top tax planning strategies for savvy real estate investors. And today, talking about taxes with us, we have Dustin Griffiths. Dustin, thanks so much for joining us.
Yeah, you bet. I'm happy to be here.
Dustin's a CPA with King's Tax and Accounting. Dustin, tell us about King's Tax and Accounting.
So we're just a small kind of boutique tax firm. We're located in the Salt Lake City, Utah area, but really service clients all over the place. I'm the primary CPA. There are two other accountants here in the office, and really ultimately our goal is to help people strategize and use the tax code to keep more of their wealth, and that's primarily done through paying less taxes.
Now, Dustin, I know you've worked with a number of real estate investors. How did you develop kind of a niche in working with real estate investors?
That's it happened organically, which is you take that if that's good or bad, but happened organically. I got involved with a couple of groups that were pretty heavily involved in real estate, whether that's agents or investors, and then it just kind of bloomed from there. I grew up, my dad, his company is real estate development. So real estate has always kind of been part of my life. It's always been something that's interested me. And as I started to get into working with people on the tax side in real estate and real estate investing, it made a lot of sense. I generally understand real estate and what's going on. And so it was just kind of a natural fit and was an easy kind of niche for me to fall into.
So this is a show kind of devoted to real estate investors and some of the legal topics and business topics surrounding that. But I want to start initially with the question of structure for a real estate investor who's either starting, maybe they've already started and they're questioning how they've structured their business, their assets. From a tax perspective, how do you recommend real estate investors structure their business holding to maximize tax benefits? How should they begin thinking about that?
Good question. So the very first thing that I would probably want to make sure that people understood is LLCs and what that means in the eyes of the IRS. And ultimately, the answer is an LLC means nothing in the eyes of the IRS. And so LLCs are great legal tools, right? But the IRS doesn't understand what to do with them. So going up and setting up an LLC potentially doesn't do anything for you tax-wise. It gives you liability protection right in the legal side, but it doesn't do anything tax-wise. And so understanding that, LLCs can be taxed a number of different ways, just depending upon how they're structured and set up and what elections you make. So LLCs being the primary business that I'm seeing people deal with, just make sure that you understand what that structure is or how the IRS is going to view it. The next step that I would say people need to understand is how the IRS taxes different kinds of income. Primarily, we're going to fall into two categories: active income and passive income. I have clients, and I don't know if you guys run into this, but they'll call themselves real estate investors and they're flipping homes. Well, that's great. Sure. That's totally fine with that. I feel great about flipping homes. Flipping homes, the IRS falls into this active category. And so flipping homes is going to be treated and taxed very different than holding a property for rents. If I am trying to wholesale a property, right, that's treated differently than holding a property for rents. If I am trying to buy a property and then sell it on a seller finance note to somebody else, that's treated differently than holding a property for long-term rents. So understanding what you're trying to achieve with that piece of real estate and what the intended purpose is will determine how the IRS is going to treat it. And that then determines what the best entity type is for that transaction. Usually active transactions dealing with active income will be best done from a tax standpoint out of an entity that taxes as an S corporation. That ultimately mitigates or allows us to pay the least amount of Social Security and Medicare tax. I'm going to put a caveat in here. If you're super close to retirement and you love the Social Security system, it's not a good fit for you. But if you think Social Security is not what it was originally designed for, I'll say it that way, don't pay into it, and the S Corp is the best way to do that. For long-term rental holds, those are usually best done in either what I would call a single member LLC or sole proprietor or a partnership, just depending upon what's involved and what's going on with the property.
Dustin, thank you so much for being here. I appreciate it. Now you and I, we've worked together on corporate structuring for some of our mutual clients. And one of the things that I think people don't understand is the difference between a limited liability company, a corporation, and a tax designation.
Okay.
Right?
Yes.
So, I've had clients who, they're like, oh, we're going to run everything through an S Corp. Okay, great. Let's do it. And next thing I know, they're off forming corporations. And, now they're having to file annual reports. And now instead of, doing an operating agreement, I'm having to do bylaws and a shareholder agreement and the whole thing. It's like, why'd you form a corporation? Well, you said an S Corp. and,
Yes.
and that's probably my fault for failing to, fully communicate what that means. I was talking about a tax reference. So talk to me about, tax classifications versus entity, types.
Sure. So I will always defer to attorneys when it comes to the legal side of the structure. And that's going to be either a limited liability company. It could be an actual partnership. It could be a PLLC. It could be a corporation, right? And I'm going to leave that to you guys. For tax purposes, primarily the IRS will primarily fit into 4 different entity structures or taxation types. Those are sole proprietor, partnerships, S corporations, or C corporations. Each entity has its time and place. Primarily for people that are going to own businesses, own them privately held companies, you're usually going to fall into sole proprietor, partnerships, or S corporations. C corporations are usually when you have lots of unrelated parties or a company that is intending to go public. All public companies are C corporations. I say that there are publicly traded partnerships, but that's a whole nother thing. So tax designations are dependent upon how the company is first set up and what we tell the IRS. So, for instance, a corporation can only ever be a C corporation or an S corporation. We don't have the ability for a corporation to be taxed as a partnership. That's never going to happen. On the flip side, a limited liability company can be taxed as any of the 4 entities, a sole proprietor or a partnership or an S corp or a C corporation. And so to your point, like, hey, let's go set up an S corporation. S corporations are only a tax designation. they actually aren't a legal entity type. Now, please tell me if I'm wrong there, but that's for all intents and purposes, it is a tax type only. And so you'll set up an LLC or a PLLC or whatever entity structure is correct for you, and you talk with your attorney about that. And then it's just a single form that we file with the IRS to say, we want you to tax treat this company as an S corporation. And that gives us potentially the tax benefits of one tax type, but you can get the legal benefits of a different entity type, right? And so they interplay with each other.
Yeah, that's exactly right. Most of the time, there's some exceptions, but most of the time, the preference for us is to form the limited liability company, especially here in Arizona, because you basically form it and forget it. You don't have to file an annual report. You don't have to pay, any type of fees or anything like that. Once you form it, and if you've designated that it's going to last in perpetuity, you don't have to do anything else. The only thing you have to do is, if you don't want it anymore, is dissolve it, file articles of dissolution or something like that. But otherwise, it just goes on, and there's no, regulation involved from our Arizona Corporation Commission versus a corporation. If you file a corporation, you have to file an annual report with a bunch of disclosures, and you have to pay the fees, and otherwise you run the risk of having the corporation administratively dissolved. So, for the most part, our preferred vehicle for entity formation is limited liability companies. But then we go to you, Dustin, and as you eloquently explained, we can go and tax those limited liability companies based upon the designation that's chosen, right? So an LLC can receive an S corporation or S corp tax designation, so it's treated the same as basically a corporation from tax purposes, in the eyes of the IRS. Talk to us a little bit about the differences between operating an LLC that's taxed as, say, a partnership versus an LLC that's taxed as an S corp.
So the primary, from the tax side, the primary differences come in how the income is taxed to the owners. So a quick clarification or a quick thing to put out there is sole proprietors, partnerships, and S corporations are all what are designated flow-through entities. Ultimately, what that means is that each of those entities don't pay federal income taxes. And for those entities in a lot of states, they don't pay state income taxes. Every state is different, so you got to check local rules and regulations. But for the most part, those entities don't pay income taxes. What they do is they report the profit or the net income to the owners, and the owners pick that up as income on their personal returns, and they tax it on their personal returns. In partnerships, I'm actually going to start with sole proprietors, if that's okay. Because an LLC owned 100% by an individual that has made no other elections or designations to the IRS files as a sole proprietor. And in the eyes of the IRS, it's just you doing the business. And in that structure, the profit or net income is subject to the following taxes. 15.3% self-employment tax. That's Social Security and Medicare tax. Then whatever your federal income tax is and whatever your state income tax is. So sole proprietors, net income are subject to all three taxes. In a partnership, you have two different designations for owners. Those designations are primarily active partners and passive partners. The importance between the designation comes in how the taxation occurs to each different type of partner. Active partners pay all three taxes. Passive partners only pay federal tax and state tax. And so the passive partner gets relief from that Social Security and Medicare tax that we were talking about. designation of active versus passive, there's a whole slew of or litany of things that the IRS is going to look at. But for the most part, if you're helping running day-to-day operations and you have significant control over the direction of the company, you're a signer on bank accounts, all of those things are typically going to put you in the active category. I will also put this out there. There is a single section in the tax code, so about 2.5 lines and 70,000 plus pages, that says the activity level of a spouse is assigned to any other spousal partners in that same partnership. So if I am a partner in a partnership and my wife is a partner in the partnership and I am active, by virtue of that single section of the tax code, my wife is considered active. And so any profits that are coming out of that entity would be subject to Social Security and Medicare tax for both of us, which means there's real no tax savings associated with that husband and wife partnership. In an S corporation, the money flows out to people really in two forms and fashions. One is to owners, and owners take distributions or draws. And the other is to what I would call directors, right? Think of it as like the CEO, the person who's running the day-to-day operations. Well, the nice thing about the S corporation is money that flows out to owners are not subject to Social Security and Medicare tax at all, only the federal and state income taxes. Well, the IRS knows this, and they know that they just lost 15.3% of their revenue and probably not very happy about it. And so one of the requirements of an S corporation is that CEO or director role has to be paid a quote unquote reasonable salary. And that's really the extent of the IRS's guidance on the salary. It has to be reasonable. Well, when we're paying a salary, we're really paying Social Security and Medicare tax as the payroll taxes. And so in an S corporation, for instance, King's Tax and Accounting is taxed as an S corporation. I wear both a hat of the CEO as well as the owner. So the portion of the funds that come to me as the pay, as my reasonable salary for being the CEO, I pay Social Security and Medicare tax on. The rest of the funds that come to me as the owner, I don't pay Social Security and Medicare tax on. And so really from a tax perspective, primarily it's all about this designation and then the assessment of Social Security and Medicare tax, or as much as we can, the non-assessment of Social Security and Medicare tax.
Our firm has kind of gone back and forth over the years. Well, I shouldn't say back and forth. We've started out as a partnership on an eat what you kill model, and then now we've gone to the S corp. But one of the things that we've over the years or knew and discovered as part of this process is the idea of unequal or uneven distributions. And, you know, the ability of a partnership to have that type of flexibility versus an S corp, you know, not having that flexibility. Can you talk to us a little bit about that?
Sure. So the term that I use in what you're talking about is called disproportionate distributions, or disproportionate allocation of profits and losses. And ultimately what that means is let's say we're in a 50-50 partnership together, but I'm doing 80% of the work and you're doing 20% of the work. Well, I might come to you and say, hey, it's fair that I'm doing the majority of the work, so I'm going to get allocated the majority of the income and I'm going to take the majority of the profits. We can still be 50-50 on assets. So if we end up selling in the company, we'll split those profits. But for day-to-day operations, I'm going to take more because I'm working in the company more. And we decide that's fine. Well, in a partnership, we're able to just do that. If we had 100,000 of net income or profit, I would take 80, you would take 20, I would get taxed on 80 and you would get taxed on 20. And it's just done that way. In an S corporation, as 50-50 owners, we're actually we're shareholders of the company. You own 500 shares and I own 500 shares. In an S corporation, you can only have what's called you can only have one class of stock. Different classes of stock allows you to give dividends or give money to owners at different rates. So in an S corporation, it's limited to one, which means if I want $1 out of our company, you have to take $1 out of our company. And so it really restricts some of the flexibility you have in terms of how funds come out. Now, in an S corporation, what ends up happening if I'm working more and more in the company, I just take a larger and larger salary than you would, and that just I'm paying the Social Security and Medicare tax associated with that. And so there's a bit of a balancing act in terms of the benefit of the S corp in the reduction of the self-employment tax versus the restriction of the S corporation in how distributions are going to end up occurring. I'm going to step in because this is up for real estate investors. Important thing to note, rental properties across the board, unless we make other elections, rental income will never be subject to Social Security and Medicare tax. It is considered a passive activity and will always be not subject to Social Security and Medicare tax. So having rental activities in a partnership is actually, from a tax standpoint, is my preferred form and function, because we're not paying Social Security and Medicare tax anyways, and it gives me the ability to have that, to have the flexibility of the partnership as opposed to an S corporation. There's another reason why we potentially don't want to do that, and we might get into that in a few minutes. But I guess to your point, there are pluses and minuses to both types. I will step to C corporations. We kind of brush past those. C corporations are taxable entities in and of themselves, so they will pay federal and state income tax. And then, as you, the owner, get cash out of that entity, you pay federal and state income tax again. So I don't love C corporations because of the double taxation, but they are an option out there as well. So I'll just throw that out there and make sure people understand that piece real quick.
So one thing, though, to understand, right, on let's say we want to do a partnership, and a lot of professional service businesses do that, for, law firms, accounting firms, medical practitioners, because frankly, sometimes one professional within that practice is producing more, working more, carrying more of the burden and bringing in more of the revenue. And so you want to reward them for that. However, in your scenario, if somebody's doing 80% of the work and responsible for 80% of the revenue, and they're taking 80% of the profit out, and the, other partners taking 20%, in a partnership, if that's going directly to that professional, they're paying that 15 and what was it, 15.5% or
15.3, but
15.3, yeah, 15.3% on that, 80% coming out, and then the 20% there, if it goes directly to the professional, them individually, they're paying 15.3 on that 20%. So I know, because you and I have worked on this, there's a solution. There's a solution to run that money through an S corp and avoid paying that 15.3, at least on a portion of it, right after you pay a reasonable salary, or reasonable W-2 compensation. What's that solution?
Correct. And so we'll put a caveat in here as we go, but oftentimes some of the structures that you'll end up seeing is that it's a partnership for our joint operating company. And then the ownership, my ownership in that and your ownership, are owned by individual S corporations. And what that does is it allows us the flexibility out of our operating company to say, okay, 80% is going to go to your S corporation and 20% is going to go to mine. Or maybe this month is 50-50, or in the case of, you get to eat what you kill, that we can do compensation based on production levels. And so that can change on a month-to-month basis, depending upon what's going on. The one caveat I'm going to put into this is you got to be careful. You can't have a company whose sole purpose is reduction and avoidance of tax. The IRS will treat that as what's called a sham entity. Okay, they're going to say, well, this only exists for that purpose, and because of that, we're not going to view it as an operating entity, as an S corporation in this sense. So generally speaking, when we get into that kind of a structure, we got to make sure that the S corporation is legitimately a company involved in other activities, right? So now a baseline operating company, King's Tax and Accounting, that's fine as an S corporation. But if King's Tax and Accounting was a partner in Taxes R Us, and all of the revenue for King's Tax and Accounting was revenue from Taxes R Us, and I had no other revenue or other business purpose, the IRS can come in and say, King's Tax and Accounting isn't really an actual entity, which causes me problems because now I'm back to having to pay the 15.3% on all of the funds as it comes to me. So it's an important thing to make sure that there's other business purposes. Clients that I work with often have multiple different entities, right? Let's say I have an operating S corporation, and that's a partner in a company, but then I have a rental property company. Well, I can help legitimize my S corporation by it receiving the management fees from the rental operating company. And now I have multiple purposes as to why that S corporation is operating, and I can help legitimize that in the eyes of the IRS in a form and function like that.
Dustin, I want to ask you kind of a more basic question.
Okay.
Real estate investors, they are going into business to do a specific thing, but what we know from real estate investing, that specific thing can mean a lot of different things. You've just mentioned passive income, active income, and while we'd all like to think that all new businesses are first going to come meet with the lawyers and then are going to go meet with you, and they're going to have a perfect, picture of what they're going to do put together. A lot of them are really just experimenting about what works for them. Maybe they're going into this to do the fix and flip. And they get into it and they don't like it and they find out they're better doing this part of real estate investing. So they're kind of working through what's going to work for them. And maybe even if they were inclined to meet with all of us on the front end, they wouldn't even know what this was going to look like a year or two from now. But oftentimes when you pick a tax designation, sometimes you can pigeonhole yourself. How would you recommend somebody kind of just starting to get the feel for this to at least begin planning, giving themselves kind of optimal flexibility as they determine and decide really what their mission's going to be in the long term?
Sure. So the very first thing, and you guys have kind of mentioned this, and that you said you like LLCs. I actually, for legal entities, I prefer the LLC the most because it's the most flexible in terms of the tax designation. You are correct that we can kind of pigeonhole ourselves a little bit in tax designations. And so the first thing I would say is determine what it is you're trying to do in real estate. Am I trying to flip homes? Am I trying to wholesale? Am I trying to be a dealer of properties where I'm buying and selling on a regular basis? Or am I trying to get involved in something for a long-term hold? And depending upon if it's any of those first items, you're probably going to want an S corporation. If it is the second item, you want a sole proprietor or a partnership. From there, you have the ability, worst case scenario, which is not ideal, but you get in, you start doing something. I get in, I start doing fix and flips because that's what I think I want. I become an S corporation. I do my first flip and I'm like, I hate this. That was such a bad idea. I want to wholesale properties. Okay, well, that's fine. Now, I would defer to you guys in terms of what the liability potential ramifications are on that. But from a tax standpoint, both of those are considered active income activities, in which case I can pivot, and having both of those in an S corporation is totally fine for me from a tax standpoint. If I get into it and I flip this property, I'm like, I hate this. Like, I just want to go buy properties and sit in cash flow. Okay, at that point, I can just set up another entity and start using that for that purpose. Where you talked about pigeonholing yourself or kind of some of the restrictions, the primary restriction is around S corporations. When I make a designation to be an S corporation, I can do that. But at any point in the future, if I elect out of being an S corporation, meaning I send a form to the IRS that says I no longer want to be treated as an S corporation, I cannot go back to being an S corporation for a 5-year period. They call it the cooling off period. So it's not like we can flip flop back and forth, and King's Tax and Accounting can be an S corporation this year and then a partnership next year and an S corp in the third year. You can't do that. And so the very first thing, again, I would say is determine what it is you're trying to accomplish. Use the best taxable entity for that. And if you choose to do something else, that's fine. The worst case scenario is we just have to set up another entity.
Now, at the beginning of the show during our legal update, we spoke about, and Sean discussed the advantages for estate planning purposes of trusts and what they can do legally. From a tax perspective, are there tax advantages in holding assets in a trust?
So the answer is there may be. Generally, the trusts that you guys were discussing, revocable trusts or grantor trusts, or I get into legal jargon and I'm not even going to go there, right? But those types of trusts, there's actually not a tax benefit. In the eyes of the IRS, revocable trusts don't exist until you die. And so it's just you. So if I have the Dustin Griffiths Living Trust, for instance, or whatever, the Griffiths Family Living Trust, that trust doesn't mean anything to the IRS until I pass away, at which point it comes into existence and there's a number of different things you have to deal with there. The other type of, so irrevocable trusts, which have a lot more restrictions on them, are really, in my experience, and please chime in if I'm going to speak wrong here, but really good legal liability protection. Once an asset gets in there, it's stuck in there and it's really not getting out. The downside of the irrevocable trust is it's going to have to file its own separate tax returns. And the tax rates associated with irrevocable trusts are very high very quickly. And so if I had $5 million or $5 million worth of assets that I wanted to leave to my kids or my beneficiaries, and they were going to create a fund that would pay for colleges or pay for whatever, an irrevocable trust might be a good solution because it's really kind of treated as its own separate entity. And I get to put this stuff in there and it can grow and it can do its own thing. And that's outside of what's happening with me personally. And so there's a time and a place for an irrevocable trust, but revocable trusts generally are what I see, and in the eyes of the IRS, they don't exist, and so there's really no tax benefits associated with those, and they don't even exist in the tax world until you pass away.
Dustin, you mentioned that we might talk later on about holding rental properties or passive producing income properties in S corps, or having, those funds run through an S corp. Talk to us about that. Are there ever tax advantages, or are there disadvantages, or should it even happen where passive income is ran through, an S corporation?
Good question. So the answer is you want to avoid it if you can. Now, if we're trying to legitimize an entity, how we had talked about the partnership owned by the S corporations, having ownership in a passive investment company, so another operating entity that you're a passive investor, I'm okay with that, actually. The biggest issue that I find is when we have appreciating assets like real estate owned by S corporations. And here's the reason why. As I get into this, I'm going to go back to partnerships for just a minute and talk about a partnership. ownership in a partnership really just represents ownership in the underlying assets of the partnership. So if I'm 50-50 with somebody and we have a $400,000 rental property in that entity, I'm really a $200,000 owner of a rental property. It's my half of that underlying asset. And so in partnerships, we can move around assets and contribute them and distribute them very easily. There's no tax consequences associated with that. And so it makes partnerships a really advantageous entity, especially for real estate. And primarily in the instance of, hey, I want to do a cash out refinance on a property that's appreciated a ton, free up that equity and maybe go buy another rental property. Well, in that scenario, the partnership just distributes the asset to me. I now have the rental property. I go do my refinance and I put it back into the partnership. In an S corporation, it is not that way. You are a shareholder of the company and the company owns the asset. And so the problem that you can run into is in the scenario of, let's say I have a rental property that I paid $200,000 for originally, and it's now worth $400,000, and I want to access some of that equity. Generally speaking, a lender is going to want to lend to me, the individual, not my company. You can find lenders out there, but it potentially gets more expensive. There's more fees. There's higher interest rates. Most of the time, it's not done that way. It's going to be done in your individual name. Well, in that scenario, what has to happen is I can't just take out the property. The company owns the property and I own the shares. And so what has to happen is the company sells the property to me at a fair market value. Well, in this case, $400,000. And I now have to pay tax on that appreciation that has occurred. And then I would do the refinance and I could put the company or put the property back into the S corporation in exchange for additional shares, but there would be no purpose in doing that, right? It's creating issues, right? The other reason why is back to this idea of reasonable salaries for directors. If I just have a whole bunch of rental properties in an S corporation, which that income, rental income, is not subject to Social Security and Medicare tax, and now I'm the director having to operate, managing 13 rental properties, I now have to pay myself a salary, a reasonable wage for managing that, and I've just created more of my income subject to Social Security and Medicare tax. So those are the two primary issues that you got to watch out for. The first one being the worst one. I mean, I had a client that their prior CPA had them putting rental properties into an S corporation, and they 2 tax years before I started working for them, they did the first refinance, and they ended up having to pay tax on, I think it was something like about $250,000 of really kind of this phantom income. And then the next year they got a new CPA and they did another refinance because the first CPA had put those properties back into the S corporation after the refinance. And that CPA, when they refinanced, that CPA taxed it correctly. And when I started meeting with them, I'm like, this is horrible. We just need these out. And at that point, they had refinanced them so often that the basis was what the fair market value was. So we were able to get them out of the S corporation without a lot of tax consequence at that time. But over the 2-year period, it probably ended up costing them $60,000 in taxes that they really didn't have to pay because it was structured incorrectly.
So my 2 takeaways here. Number 1, keeping rental properties in partnership taxed entities provides more flexibility. And number 2, make sure you have a good CPA that knows what they're doing in the real estate arena. For sure. Yeah. Definitely.
And I'm gonna jump in on that. Not only a good CPA, but make sure your attorney understands what you're trying to do. Because I've chatted with attorneys before for clients, and it's like banging my head against a wall. So make sure that the attorney can also understand what you're trying to do.
Definitely agree with that one.
Dustin, are there special rules or exemptions that allow real estate investors to claim expenses that are not otherwise available to, the average Joe Blow
Ye-
taxpayer?
Well, yes and no and kind of. So I'm gonna talk first about
Lawyers love that kind of answer.
well, yeah, it depends, right? And that's unfortunately, I'll talk to clients and I will often say to them, if you ask 10 different CPAs the same question, you're probably going to get 13 different answers. So, it's you gotta make sure that whoever the professional is has all the facts and circumstances.
Yeah.
So the first thing I would say is deductions are deductions. The IRS says they have to be ordinary and necessary for production of the income. And so as long as we're doing that, partnerships, S corps, what I would call a real estate professional, which we're going to talk about that designation in a minute, versus non-real estate professionals, those deductions generally are going to be the same. Where things get really fun for real estate investors and people that are involved in real estate heavily is what's called the real estate professional designation. And why that makes a difference is it deals with the ability to deduct rental losses to offset ordinary income. Non-real estate professionals cannot deduct rental losses to offset ordinary income, subject to certain limits. If you're under $150,000 of all income, you can take up to $25,000 of a rental loss. Any excess losses get carried forward to offset future rental income. So let's say I make $200,000 and I have, because of depreciation and rehabbing and whatever and getting a property ready for rent, I have, let's call it a $30,000 rental loss. I can't use that rental loss, that $30,000 rental loss, to offset my $200,000 of income. That $30,000 loss just gets stuck in a bucket on the side and it just waits until I have rental income. Now, a real estate professional does not have that limitation. Rental losses can offset all of their other ordinary income. So let's talk about the designation for just a second. The designation, primarily you have to meet two requirements. First requirement is you have to be working in a real estate industry for at least 750 hours a year. And second, you cannot do anything else more than that. So no other activities. So let's say I did rentals and flipping houses 800 hours a year, but I did tax work 1,000 hours a year. I still don't get this real estate professional designation because I didn't meet the second requirement. But if I can meet both requirements, this is awesome, because now all of a sudden I can use rental losses to offset my ordinary income. And in that example, I mean, I have some clients that probably this year, from operating entities in the real estate world where they're real estate professionals, wholesaling, flipping, being dealers of properties, are making, 7 figures plus a year. And we're paying taxes on almost none of it, because at the same time, they're acquiring investment real estate properties, right? Rental properties. And we're creating losses off of those rental properties to offset their operating income. And it's awesome. I mean, the most I've had in 1 year is about $4 million that we offset through real estate rental losses, offsetting ordinary income. So it can be a pretty sweet tax haven if you qualify as that real estate professional.
So is the real estate professional designation limited to investors? Or let's say I'm a real estate licensee, I'm helping people, I'm representing people buying and selling, but then I have my side business doing investments. And there's a lot of real estate investors that are out there that do that, right? They kind of work in both spaces. Does my work as a real estate licensee qualify me for that real estate professional designation?
The answer is it has to be, so your activity has to be in a real estate related industry. So being an agent, helping buy and sell properties, flipping homes, managing rentals, wholesaling. Well, we were already talking about, I would not say construction of new properties. I think you get into construction industry, not real estate industry, right, at that point. And so making sure, you want to make sure you talk to whoever your professional is about what qualifies for those designations. But in the example you bought, yeah, if I'm a real estate agent, right, and that's what I do on my day-to-day, I'm helping people buy and sell real estate. That is a real estate activity, in which case the time that I'm putting in as a real estate agent counts towards my 750 hours to meet my real estate professional designation. And it also doesn't get in the way of me doing something else more than real estate, right? One area that I would say you'd have to watch out for and is mortgages, right? Mortgages, if I'm a mortgage lender lending on real estate, I am not a real estate professional. Those hours don't count because I am not in the real estate industry. I'm in the lending industry. And so you need to watch out for specific, like, just clarifications and designations like that. But if I'm a real estate agent, totally. Matter of fact, I probably have, I don't know, a couple, 300 or 300 clients that are real estate agents or real estate investors or a combination of both. And we're taking advantage of depreciation rules to offset income. And it's great. Right now, it's great. It's going to become less great over the next 4 years, according to current tax legislation. So I will.
What about an attorney that exclusively represents real estate investors?
You should have one of those.
No, but would they qualify for the real estate professionals designation?
I'll be honest. I think the answer is probably no, because you're still in the legal world, right? You're in a legal industry, not right. It's not the real estate specifically that you are working on. It is the legal items that surround the real estate. Now, that would be an interesting thing to go potentially ask the IRS for what's called a private letter ruling, right? If there's ever enough ambiguity and you need some real concrete answers from the IRS, you can write them a letter that says, here are the facts and circumstances. My understanding is this. You tell me if it's any different. And they'll come back and they'll give it to you. And that is direct application of the tax code to your scenario, and can be quite valuable. I have a different client that I'm working with that we are potentially going down the route of private letter rulings for a scenario that they're involved in, which could save them taxation on hundreds of thousands of dollars a year in perpetuity until they're done. So it can be a big deal.
Well, we may be looking to do that. A lot of my work is, with investors. I'm doing a lot of their contracts and then I do some commercial real estate work in which I'm there, doing some of the negotiation work, kind of walking a buyer or seller through, the purchase or sell of a commercial space. I'm guessing that probably would work. But then when I'm doing like the organizational structuring and stuff like that, I couldn't count those hours. I'm guessing.
Correct. So if you are helping a client, helping someone purchase real estate, that fits kind of in that real estate agent realm.
Right.
And so if I'm advising them on like, okay, this is going to be a rental property, and in this area, occupancy rates are this, and rents are going at this, and so this is what this would look like for you as an investment, I wouldn't have a problem, according to what I read in the tax code, assigning those as real estate professional designation hours. Now, if I'm then like, okay, we're going to your point, hey, let's set up this LLC for you to hold the real estate in, I would not count those hours.
Right.
Dustin, briefly want to just ask you about a capital gain tax.
Okay.
Really, the most important two questions as far as I'm concerned. What are they and how do we avoid them?
So, capital gains tax. Capital gains tax are taxes on investment assets that are being held. most of the time, capital gains tax falls into two different categories: short-term capital gains versus long-term capital gains. Short-term deals with assets that are held less than 1 year. Long-term are an asset that is held 1 year and 1 day or more. Long-term capital gains tax rates are actually less than ordinary income tax rates by 7 to 17% in current tax code. So if I had something where I could be considered active and I could sell a property that is considered active income to me, or I could have it, if I had the opportunity to have it as a long-term capital gain, I want the long-term capital gain because it's saving me 7 to 17%. Now, where people typically, especially real estate investors, get into potential problems is with rental properties or investment assets that they've had for a number of years that they have taken depreciation deductions on. And when we get into that scenario, there's what the IRS would call depreciation recapture. And so if I had, back to the example we were using with the entity structuring and not wanting a rental in an S corp, let's say I have a property that I bought for $200,000 and it's now worth $400,000. Well, if I've depreciated $100,000 worth of that property, I actually pay ordinary income tax rates on the first 100,000 or depreciation recapture rates. And then on the next 200,000, I pay long-term capital gains rate. So I'm actually paying tax on $300,000 of that transaction at that point. And depending upon your scenario, it's really might not be a good time to do that. Generally, we're not avoiding capital gains tax on investment properties. There is one caveat to that. The way that we can avoid capital gains tax on investment properties is by continually trading up properties through what's called a 1031 exchange, which is where I'm deferring tax to when I would sell the next property. And as long as I keep doing a 1031 exchange, it continues to defer until I die, at which point my estate receives what's called a step up in basis, and I can mitigate a whole lot of tax at that point. So there's the when to sell properties and how to really comes down to facts and circumstances for each individual situation. But if I'm not interested in paying tax now, and I just want to get out of one property and into another property, 1031 exchanges are the best options.
It's been in the news. We've all heard about the Inflation Reduction Act. And if you're like me, you can feel the inflation melting away since its passage. But I'm curious, are real estate investors, could they stand to be negatively impacted by the passage of that, or is it still too soon to tell?
Generally speaking, no. The vast majority of that bill deals with C corporations and reinstatement of some nice tax breaks that they were getting or reduction of taxes. And it deals primarily with the energy, like alternative energy segments, wind, solar, geothermal, right? Those kinds of places. So generally speaking, in what I have read so far, no, real estate investors shouldn't be stressed about it. The area that I think widespread Americans are most worried about are the $87 billion over the next 3 years that's going to the IRS of additional funding.
Well, that was going to be my next question. Yeah. So what are some best practices a real estate investor or any business owner should employ to be prepared for the possibility of audits, right? That's what I think most people fear.
That's exactly right. It is fear of audits, and the IRS has come out and said we're gonna go after flow through entities a little bit more. So those are typically lower dollar figure audits, meaning the IRS has less chances for large revenues compared to like a C corporation, but there's still potential revenue there for the IRS, and they want to start going after them. So best practice is are, number one, make sure you have a good CPA or accountant that's helping you out, that's advising you on what you can and can't do, and is making sure that filings are done properly. The second thing would be, it's all about documentation under IRS audits. Why we're doing what we're doing and tracking what it is that we are doing. The worst audits are one that somebody gets audited and the IRS says, okay, provide me with your financial statements for your business. And they say, well, what are those? Right? Like that's no good. At that point, you are
on the back of the napkin somewhere.
That's right. You're trying to swim upstream, up Niagara Falls kind of a thing. You're dead in the water at that point. So making sure that your information is documented. An example of a great turnout is client got audited. This client was very meticulous. And usually when you get audited, it's going to be for a 2 to 3 year period. The IRS is usually auditing 3 years in arrears, and they'll audit from that time to current. That is an ordinary practice. And so he got pulled for audit. The auditor said, okay, I want to have this meeting. And he walked in with 3 banker's boxes. And those banker boxes had folders for every month. And within those folders for every month, he had a folder for every single category of all of his deductions. And inside those folders were receipts. The auditor pulled off 2 box lids, went through about 15 folders, put the box lids back on, and said to the client, have a nice day. And that was it. I mean, at that point, he knew things were all buttoned up. Now, areas where I would become nervous for audits, of like things that would potentially raise flags for audit, are lack of officer compensation in S corporations, or significantly underpaid officer compensations, meals, right? If somebody is claiming $30,000 of business meals, unless you have significant revenue and we're talking about you're hosting events, like that's a lot of meals. I don't even know that I could spend $30,000 a year eating out. Like, I feel like that's hard for me. So meals is one area that I would be careful of. The other thing that I would say I would watch out for is losses being shown on sole proprietors. Oftentimes people will start a business, show losses, and then close the business down. I would worry about that, because there's a specific designation in the IRS code that deals with what are called hobby losses, and we don't want to get pushed into this IRS designation of a hobby loss. So we want to make sure businesses are legitimate. So first, having a good CPA. Second, making sure you've got good documentation and financials.
Well, Dustin, thank you so much. This information has been unbelievable. We really appreciate it. Where can our listeners connect with you?
So I'll be honest. I do not even have a website. How's that for horrible?
Well, we can't point them to the yellow pages anymore.
We can't go to the yellow pages. I think I might have one LinkedIn page that I set up a long time ago, but best thing is, if you have specific questions or want to talk about your specific situation, best thing is to just get a hold of our office. Office phone number is 801-980-9495. You call and you say, hey, I heard Dustin on the podcast. I've got questions about my specific situation. And one of our accountants will get you set up with one of the accountants, and we'll make sure to get those questions answered. The other is we have an email address. It's just office@kingstaxllc.com. And you can shoot an email there saying very similar thing. Hey, I heard Dustin on the podcast. I'm looking for a consult on what I have going on and what the best things are for me. And we'll get in touch with you and help take care of you from there.
Well, that is perfect. Thanks so much, Dustin, for joining us. We'll see you next time.
Okay. Thanks, guys. Appreciate it.
All right. With that, everybody, that is the end of our episode. Join us next week. We're talking about why flips fail. That should be a good one. We'll see you guys next week. Thank you.
Have a good day, everyone.